Welcome. This presentation explores the two types of charitable remainder trusts, or CRTs, the Charitable Remainder Annuity Trust, or CRAT, and the Charitable Remainder Unitrust, or CRUT. In another video, I discuss CRTs in general. Let's start with a brief review of CRTs and then turn to CRATs and CRUTs. A charitable remainder trust, or CRT, starts when a donor transfers assets into the trust. The trust makes specific distributions at least annually to one or more non-charitable beneficiaries for the beneficiary's lives or for a specific number of years. The grantor, along with the grantor's spouse, can be and often is the beneficiary. At the end of the term, the assets remaining in the trust go to one or more charities. The charity is called the remainder beneficiary. The two main variations of charitable remainder trusts are the CRAT and the CRUT. Those are not just four-letter words. The CRAT pays a fixed dollar amount or a fixed percentage of its initial value to the non-charitable beneficiaries at least annually. The CRUT pays a variable amount to the non-charitable beneficiaries, which is a percentage of the net fair market value of the CRUT as valued each year. With a CRAT, the non-charitable beneficiary receives an annuity. An annuity is a specified percentage of the value of the assets first contributed to the trust. This amount does not change from year to year, but remains the same throughout the term of the trust. A CRAT provides a steady, reliable source of income to the non-charitable beneficiaries, who are often the donors or grantors. Each year, they can count on receiving the same specified amount. Because only the initial value of the CRAT matters, its assets are valued only once, when the CRAT is first funded. A CRAT ensures payouts to the non-charitable beneficiaries remain steady even if assets in the trust go down in value. A CRAT does have some limits. It can be funded once and only once, so no additional contributions can be made. Distributions to non-charitable beneficiaries cannot be delayed with a CRAT. Therefore, the income from a CRAT cannot be deferred, and it works best for liquid assets. A charitable remainder unitrust, or CRUT, is more flexible in part because it comes in several different variations. The charitable remainder unitrust, or CRUT, pays a variable amount to the non-charitable beneficiaries each year, which is a percentage of the net fair market value of the CRUT as valued annually. Yes, this means that the assets in the CRUT must be valued each year. This can be costly for assets that are difficult to value, including business interests. The CRUT comes in several variations, including the Standard CRUT or SCRUT, the NICRUT or Net Income Charitable Remainder Unitrust, the NIMCRUT or Net Income Unitrust with Makeup Provisions, and the FLIP CRUT or FLIP Unitrust. The SCRUT works well for donors who want to receive payouts from the trust each year. The payout to the non-charitable beneficiaries of an SCRUT is always the same percentage of the trust principal. Because the value of the principal differs each year, however, the payout changes. The assets can be valued on any day of the year, but they must be valued on the same day each year. Usually the trust is valued on the first day of each taxable year. When assets in the SCRUT appreciate, the payouts to the non-charitable beneficiaries increase. The annual payouts from an SCRUT cannot be deferred. They must start when the trust is founded. Therefore, the SCRUT does not work well for assets like real estate, businesses, or boats, which must be converted to cash to make payments. The NICRUT uses the net income method to calculate payouts to the non-charitable beneficiaries. Under the net income method, the annual payout is the lesser of a fixed percentage of the net fair market value of the trust assets valued annually or the amount of trust income for that year. If the NICRUT has no income, the non-charitable beneficiaries receive no payouts. The NICRUT works well for difficult-to-sell assets like valuable art. If the art were placed in an SCRUT, the trust would have to sell the art immediately to start payments to the beneficiaries. The NICRUT also maximizes the value received by the charitable beneficiary. On the other hand, the non-charitable beneficiary's annual payments will be less predictable and often less than would be paid from an SCRUT. A NIMCRUT starts with the same payout to the non-charitable beneficiaries in a NICRUT, that is, the lesser of a fixed percentage or the trust income. A NIMCRUT differs because it also has an IOU makeup account. The IOU account is the sum of amounts that would have been paid under the fixed percentage in previous years if the percentage were less than the trust income. The main advantage of the CRUT is the ability to defer income for the non-charitable beneficiary into future years, when the makeup payments are made. On the other hand, this can lead to a large payment in one future year, which may have adverse tax consequences on the non-charitable beneficiary. The CRUT is best explained by an example. Charlie funds a CRUT with $100,000. The annual Unitrust amount payable to the non-charitable beneficiary, which is also Charlie, is the lesser of the CRUT's annual income, or 5% of its value. In the first year, the trust assets are valued at $100,000, and the trust has $4,000 net income. The distribution to Charlie will be $4,000 because the net income of $4,000 is less than $5,000, which is 5% of the trust value. Because the income is $1,000 less than the Unitrust percentage amount, the IOU account owing to Charlie is $1,000. In year 2, the trust is worth $120,000 and has $8,000 in net income. 5% of the trust value is $6,000, which is less than the net income of $8,000. The CRUT distributes to Charlie $6,000 for year 2, plus the $1,000 owing from the IOU account, for a total distribution of $7,000 in year 2. The flip Unitrust, or flip CRUT, is the final variation of the CRUT. A flip CRUT starts as a CRUT or CRUT. Upon a certain date or a triggering event specified in the trust, the flip CRUT flips or changes to an CRUT. Then regular payments of a percentage of the annual value of the assets to the non-charitable beneficiaries begin. This is an excellent retirement planning strategy. During their high-income earning years, the donors establish the flip CRUT and claim an income tax deduction. When the donors retire, the trust flips to an CRUT and becomes a regular source of income for them. The IOU account from a CRUT disappears upon the flip, but if the donors wish to collect from the IOU account, they can arrange to do so in the year before the flip. This makes the flip CRUT an extremely flexible planning tool for obtaining tax advantages, preparing for retirement, and supporting charity. I'm Daniel Van Slyke, attorney at law. As you can see, charitable planning is extremely complicated. If you'd like to discuss your options for charitable planning, contact me at iplanlaw.com.